The Federal Reserve meets next week and will have to adjudicate on a titanic tug-of-war between economic and market data. On one hand, while the US economy continues to grow at a respectable pace, recent data has been patchy. Most of all, last week's jobs report, coupled with still subdued inflation and the dimming outlook for any meaningful policies in Washington, should indicate that policymakers should tread carefully. On the other hand, so-called financial conditions, the net impact of market measures like currency movements, equities and bond yields, are screaming that the Fed should get a move on. Indeed, despite 2 rate increases since last December and expectations that the central bank will this year begin to unwind its crisis-fighting stimulus, financial condition gauges have actually fallen further this year. Now, this indicates that markets think the Fed is not tightening policy as much as it is paring back superfluous accommodation. And this seems to be the Fed's thinking. And as a result, the market-implied probability of a rate hike is running at about 97%. The Fed is probably right to tighten policy next week. The economy is far from sickly after all, and the recent softness could prove transitory, as most policymakers believe. However, it still raises thorny questions for a central bank that has long been at pains to insist that it is data dependent, not markets dependent. Dressing it up as financial conditions doesn't negate the point that at the moment it appears to care more about buoyant markets than the dimming economic data. Indeed, financial conditions are at least partially easy because the bond market is glummer on the outlook than the stock market, which has depressed yields and the dollar, which are big components in most financial stress indices. A June interest rate increase is already baked into markets, but this could mean that the promise of more to come later this year could prove a challenge to digest, given the already diverging views of bond and equity investors. Fixed income markets are pricing in just 3 more rate increases through 2019, including June's, but the US stock market is still reflecting a far more optimistic scenario. And if history is any guide, then it is equity investors will have to lose this market tug-of-war.